Hi, I'm Steve. I'm going to share my thoughts on how you can achieve a better financial future. Please remember, I don't know anything about your situation, so think for yourself and use what fits. Welcome back to our conversation on debt investing. A call provision is a common feature of bonds. If rates drop, the issuer has the right to buy back the security at a certain price once a specific amount of time has gone by. A 7-year maturity bond, for instance, might be callable after 4 years. It's very similar to a homeowner refinancing their mortgage, except the homeowner can do it at any time. The face value of a bond is the amount the issuer borrowed from you. If the bond sells for this exact amount, it's referred to as selling at par. Bonds rarely trade at par after being issued due to interest rate fluctuations. Finally, there are two types of yield terms to understand. The first is simply called yield, coupon, or yield to maturity. If the bond says 7%, then all these terms will be 7%. This would be the end of the story, except for two things that are captured by the other measure, yield to worst. This measure assumes an issuer uses the call provision mentioned above as soon as they can. It also accounts for the fact that you rarely purchase a bond at par after it's issued. Changes in interest rates cause the price to fluctuate. When looking at yield, focus primarily on yield to worst. Let's wrap this one up. Short-term debt is a great way to hold money you'll need in the next year or two, and a modest amount of long-term debt can reduce the volatility of a stock-based portfolio. Short-term debt is pretty simple. Just invest in high-rated bond funds. For long-term debt, learn the terms described above and do your diligence before investing. It can be a very good investment, but the details are much more complex and deserve careful study. Well, that's it for this session. Thanks for watching, and I'll see you next time.